Everyone argues about real estate versus stocks at every dinner table, every podcast, every comment section. But almost nobody actually runs the math. Today, we will. For decades, these two assets have built more personal wealth than almost anything else on Earth. Real estate has quietly compounded value across generations, slow, steady, tangible. To compare them properly, we need four numbers: leverage, cash flow, appreciation, and liquidity. Ignore any one of these and the comparison is meaningless. Real estate's biggest advantage is leverage. A small down payment can control a much larger asset. Put down 20% and you control 100% of the gains and 100% of the risk. Stocks don't usually offer that kind of leverage, but they offer something else: frictionless compounding. A small snowball rolling consistently becomes an avalanche of value. That's the stock market, over 30 years. But neither asset moves in a straight line. Both have humbled investors who forgot that risk is real. 2008 proved that real estate can collapse just as violently as any stock, wiping out a generation's equity in months. And the dot-com crash, then 2008 again, proved the same about stocks. Paper gains can vanish overnight. Here's the difference that matters most day to day: cash flow. Real estate can pay you monthly. Most stocks ask you to wait. But that cash flow has a cost: maintenance, taxes, vacancies, and years where you simply cannot sell quickly. Stocks flip that trade-off entirely. Instant liquidity, but almost zero control over the asset itself. The real math doesn't crown a winner. It shows two different tools built for two different jobs. The smartest investors don't pick a side. They learn how each one actually works and use both. If this helped, subscribe for more of the real math behind money.